In fiscal dominance, almost everything the central bank does is wrong. That's the problem. Because if they hold interest rates high, so go back to kind of what we said earlier, the primary purpose of raising interest rates is to slow down bank lending. The problem is that the whole period of inflation we've had for the past 5 years was not caused by excessive bank lending. It was caused by those fiscal deficits. Originally, it was intentional stimulus, and now it's just this background higher deficit. So the Fed, in some ways, has been trying to raise interest rates to slow down bank lending to offset the real problem, which is federal deficits. But by doing so, because the debt's over 100% GDP, by keeping interest rates high, they're also actually keeping the deficit high because they're keeping federal rates high. And yet, if they cut interest rates while you have stocks at all-time highs, gold at all-time highs, Bitcoin at all-time highs, property values at all-time highs, then they're adding fuel to the fire too. And that's why you get to that statistic where 98% of economies, when they reach these debt levels, tend to have some sort of default, which can be through purchasing power, because their own central bank kind of runs out of options. And so I think that it's probably due for a mild cut just based on the deterioration of economic conditions. But I view that as a much like a smaller lever to pull than the fiscal situation. One way of putting it is that when the money's weak, people will monetize other things. And then by doing so, they make those things less available to those who just want to hold them for their actual utility use, not their monetary use. And so by monetizing our equity market, by monetizing our real estate market, because our money's weak, it causes all these more structural imbalances, and therefore it causes periods of malinvestment, and it causes that kind of, along with other policy decisions, those high levels of wealth concentration.